And how much of this is flight to safety? After all, we heard New York Community Bank under duress has now been taken over, and there's another bank in Philadelphia. So there's no counterparty risk when it comes to Bitcoin. And so maybe that's part of why Bitcoin has shot up here. And as you know,
Hey guys, welcome back to Everyday Finance. In this video, Cathie Wood discusses Bitcoin and crypto. According to Cathie Wood, the Bitcoin price reached a new high, touching intraday levels on a couple of occasions. Days when $70,000. One can't help but wonder how much of this is due to the recent ETF launches and all the media attention. The level of competition among the 11 ETF issuers and the extent of their involvement, seeking refuge in safe assets. Well, it seems that New York Community Bank is currently facing some challenges. Now, under new ownership, there is another bank in Philadelphia. There is no counterparty risk associated with Bitcoin, which could explain why its value has significantly increased, and lots of things Cathie Wood discussed, so please watch the video to end. And share this video, and subscribe our channel Everyday Finance. Thanks.
Here's the Bitcoin price out to a new high. It did touch intraday on a couple of days, that 70,000. And, we wonder how much of this is because of the ETF launches and all of the publicity and the competition among the 11 ETF issuers. And how much of this is flight to safety? After all, we heard New York Community Bank under duress has now been taken over, and there's another bank in Philadelphia. So there's no counterparty risk when it comes to Bitcoin. And so maybe that's part of why Bitcoin has shot up here. And as you know from our research, we think this journey has miles to go. And this is the true puzzler for us. So these are credit default swaps, and they have been coming down. And they came down especially after the Fed put in place that long-term, the funding mechanism in response to the regional bank crisis. Now that's going away on March 11th. Let's see what happens. Could be fireworks. I don't know. But there's another thing that could be going on. And it's back to all of the money, the capital flowing into private equity, private credit funds that don't have to market like we do every day. And to many people, that's a lot more comforting than watching the volatility in the public markets. Well, mark my words, if we're right on multifamily, there are going to be some dramatic mark-to-market moments in those worlds. But we've seen capital stretching for yield in apartment buildings, at one time office buildings, in warehouses, and so forth. And maybe we're going to see the other side of that after this long-term funding facility ends. Now let's take a tour through some market indicators. The dollar is, again, in perspective, the dollar has been moving up for nearly 10 years on balance. While many people focus on, the last year or something and say, oh, the dollar's weak. The dollar is in an uptrend. And that is a very deflationary phenomenon. Most commodities are priced in dollars. And so here you can see the Bloomberg Commodity Index, and it has been in a downtrend since '08. And here I like to explain what caused that spike in '08. It actually started in the late 90s. When we had a number of reasons for the Fed to stimulate. Russia defaulted, causing uncertainty, but it wasn't until long-term capital went under and threatened the financial system that the Fed really started easing. That was in '98. And then in 1999, they eased even more out of fear that Y2K, the turn of the century, would knock all the computers in the world out and the economy would shut down. And then during the tech and telecom bust, after the economy did not shut down, but tech and telecom did go bust, the Fed stimulated again. And you can see what happened. It caused that price spike. I want you to remember back to the yield curve, that underlying deflationary undercurrent. This is what I mean. This is a downward trend in commodity prices that started in '08. And it's resuming its downtrend. And strikingly, commodity prices today are where they were in the early '80s. I think many people are surprised to hear that. Of course, technology is a reason. It's easier to get commodities out of mines and so forth. So that's an explanation. But this suggests that it's not inflationary, that we're not living in an inflationary period today. And that the reason we did have that inflation spurt was a massive supply shock around COVID. And then another way, and I showed you this last time as well.
According to Cathie Wood, this is a challenging puzzle for us. ARK is currently dealing with credit defaults. Swaps have been decreasing recently, gradually declining over time, especially after the Fed implemented that long-term, policy, exploring the funding mechanism in response to the regional bank crisis now. That's going away on March 11th. Let's see what happens. It could be quite exciting. Cathie Wood, there might be another factor at play here, circling back to the previous point. All of the money and capital flowing into private equity and credit investment vehicles that do not require daily mark-to-market valuation, unlike our routine practice, are quite abundant. It's much more comforting to observe the stability in the market rather than the constant fluctuations. If ARK predictions about the multifamily sector in the public markets are correct, ARK can expect some significant developments. In those worlds, ARK has observed moments of market volatility. However, ARK has also witnessed instances of capital reaching for new opportunities. Yield in apartment buildings, office buildings, and warehouses. Considering the current circumstances, it is possible that ARK may witness a shift in the situation once the long-term funding facility comes to a close. Let's back to the Cathie Wood interview.
Metals to gold. So this gives us a sense of gold's purchasing power. When the periwinkle line is moving down, gold's purchasing power in terms of metals is increasing. And you can see how tightly correlated this ratio has been with long-term interest rates, certainly since '08-09, but even there was a correlation before '08-09 directionally, until the Fed started tightening. And I think what this is telling us is gold's purchasing power going up in terms of metals is telling us we're in a bit of a deflationary period. And there's been a little bit of a flight to risk-off assets. But you'd never know it from the Treasury yield because the Fed has been so tight. The only way we see the Treasuries expressing concern is through that inverted yield curve. Now I'm going to show you a couple of charts that are puzzling, somewhat puzzling. You can see that gold is breaking out here. Is this a flight to safety? Are there things going on out there, whether it's commercial real estate in the US or recessions around the world or crackdowns in China and Russia and elsewhere? Is there a flight to safety? We don't know why the gold price is going up like this, but it is interesting to note that the metals to gold price is still near a very low level, near recessionary levels. So that's kind of interesting.
According to Cathie Wood, when examining the rent data, one can identify 3 distinct metrics. The first one, indicated by the green line, corresponds to the apartment list. At one point, the rent index experienced a downturn. Cathie Wood didn't focus on the COVID situation for an extended period before it began to surge rapidly. As individuals transition back into the workforce and establish their independence, many find themselves facing a familiar scenario where the outlook is not as optimistic as it once was. Let's analyze the results and explore these alternative rent indexes that we will closely monitor and track the movements of the CPI. Based on the Zillow Rent Index, it is clear that the rates are currently at 6%. Shelter is the largest component of the CPI when compared year over year. Thus, if this pattern persists and continues to track the decline in rent, it could potentially reach negative levels. With the increase in units entering the market, the territory is undergoing some changes. Reaching unparalleled levels of success, we haven't seen numbers like this since the extraordinary speculation. Back in the inflationary 1970s, real estate was a hot choice for tax shelters. However, it appears that times have changed, and now there is a growing belief that rents will actually decrease. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.